Welcome, everyone. Thank you so much for joining us for our annual ESG webinar. My name is Kali Hassinger, and I'm a senior financial planner at the Center. ESG investing is something that is both professionally and personally an interest for me. I've studied ESG investing, which is what those CSRIC letters are referencing behind my name. But I'm also lucky enough to work at a firm where I'm not alone in that interest. And I'm joined today by my friend and colleague, Mallory Hunt. If you're a current client, you probably know her name from receiving her trade notification emails, but Mallory does so much behind the scenes on behalf of our clients. So I'm really excited that she's part of the presentation this year.
As Kali mentioned, I am Mallory Hunt, and I am the portfolio administrator here at the Center. I've been here for about 5 years now, and over the past 4 years, I've had the privilege of being part of the investment team. And I'm really excited to be here with Kali today to talk through everything ESG, and particularly the investment side of things.
Thank you. Awesome. So our agenda today is going to review ESG investing from a few different angles. First, we'll define ESG investing specifically to better understand the many factors that can be considered when incorporating this strategy into your investment approach. We'll then take a deeper dive into ESG investing strategies and how they can be incorporated into both analysis of companies and investment reviews. We'll briefly discuss a bit of the regulatory background that has influenced ESG investing. We'll review how that environment has impacted access to ESG risk ratings, both the benefits and limitations that these ratings can offer. And then finally, Mallory is going to round it out with the Center's approach to ESG investing and, of course, our portfolio construction. So starting with the very basics, what is ESG? ESG is an acronym for environmental, social, and governance. And it's an umbrella term used to describe the individual criteria used to evaluate investments through that ESG lens. These criteria are categorized and they can be incorporated and evaluated throughout any investment process. If you're like many people, when you hear that environmental classification, that's most often what people think of when they hear ESG, but it's actually one of the only one of the guiding pieces. With these three factors, these three guiding factors, again, environmental, social, and governance, there are many ways to interpret that framework. The words within the pie chart, they might be hard to decipher here, but it helps to illustrate that there are many elements of ESG investing that can be considered when reviewing any company or looking at analysis with an ESG lens. So looking at the E or environmental piece first, this isn't only carbon or carbon emissions or climate focused. There are other aspects that are evaluated. Examples are the use of natural resources, assessing if these resources are being managed responsibly and sustainably. Another example is examining how much waste and pollution a company creates or how much water they use throughout their production process. The social classification here in blue focuses on the treatment of and consideration of people and relationships. That's a little wordy, but a few examples shown here: workplace safety, employee benefits, community involvement. Are they developing communities around them? This factor can be really as basic as, is this company in the news for any human rights violations? Hopefully not. But it can be that simple. Lastly, the governance lens focuses on the standards and practices of how a company is run, and we see that in orange here. A few examples related to executive and CEO compensation, board diversity, any policies the company may implement to fight corruption. So Between these three categories, we have incredibly varying ways to review a company or review an investment opportunity. And these views can often conflict with one another. Example, really basic example, a company could have a very low carbon footprint, be a thought leader in sustainability. However, they may simultaneously overwork employees and have minimal internal practices to protect those employees. So, this would score the company very well on an environmental lens, whereas from the social and governance aspects, pretty poorly. So, again, this is very basic, but when reviewing these factors, it's ultimately up to the analyst to determine how are they going to interpret this. And most often, the pieces that they choose to consider is determined by the investment goal of that fund or that analysis review. The history of ESG, and one of the first approaches that existed with ESG is called the exclusionary approach. The roots of ESG, the roots of this approach specifically, go as far back as the 1700s with the Quakers. The first formal investment fund, again with that exclusionary approach, dates as far back as 1928. And these were both very religiously motivated. So the first fund, the Quaker approach, they purposefully excluded any investments that were viewed as sinful. One example that still may come into play today, tobacco, that was excluded, but it has, of course, expanded to include different industries and ventures that just may not align with an individual investor's values. Fossil fuels, animal cruelty, and even the weapons industry. So the issue here and the criticism of this approach is that it can limit your investment options and end up reducing exposure to what we consider very standard investment sectors or standard pieces of a diversified portfolio. So that's most often the argument against this approach, and the worry that ultimately this exclusionary strategy can end up varying performance, especially as it compares to the broad benchmarks. And, that's just a nicer way to say people worry that performance will suffer. So there are still investment funds that use this approach. There are still religious investment funds that use this approach. But of course, ESG has significantly evolved over the years, so much so that the environmental, and I touched on this earlier, or sustainability themed approach of ESG investing is what people most often think of when you hear ESG or ESG is mentioned. I've already explained how there are many other aspects to consider with ESG when you consider all those factors, but sustainability is still very much a prevalent goal within ESG investing. We'll talk a little bit later about how the E has really driven some of the exposure and continued progress within ESG investing. And it's still, when you think of the sustainability theme, it's still an effective way to align your values with your investment portfolio. Very similar to that exclusionary approach, however, the pushback that this can receive is, are we going to inadvertently reduce our investment universe? Will this be another issue with lagging performance? So a way to avoid this reduction in your investment choices or asset classes is by using the approach we see here, the best-in-class approach. And this more or less screens companies to see who, as compared to its peers, is doing the best in one or more of the ESG related factors. Not necessarily doing well, but doing the best compared to its peers. So it can be, fossil fuel related and have negative environmental impacts, but compared to its peers, is it trying to get better? And the hope with this approach is that you still maintain diversification, you have exposure to all industries, all sectors, but when you look at a company that is trying to do the best, during periods of unforeseen stressors, the companies will perform well. Again, at least compared to its peers. There could be, of course, periods of negative performance, as with any investment, but hoping that the ability to adapt, it will do slightly better. And, it's just really the basic idea that companies who are aware of their risks, they're maybe making some changes to improve, treat employees well, have employee loyalty, they're well managed, they will be more resilient and are better investment opportunities. And this is where we're really seeing the evolution of ESG. We're not excluding asset classes anymore. ESG is used as a lens to evaluate the risks that companies may face based on internal and external factors. So those environmental, social, and governance factors and challenges. So the world's changing, companies and everyone, right? We're all ultimately, our lives are impacted by factors outside of our control. The same as for any company, any investment. Regulation specifically for investment reviews, that is ever evolving and changing. Society is always evolving. And technology, can we keep up with technology? So a business really either needs to be able to defend themselves against those changes, or they are able to adapt quickly and adapt along the way. So with ESG analysis, we can try to determine how much risk a company inherently possesses based on those ESG factors, not necessarily screening companies out of an investment portfolio, maybe not even choosing companies only based on ESG factors, but rather just having a better understanding, shedding light on, is this company, is this investment more susceptible to issues that you might not see just, when reviewing a balance sheet or reviewing financials. So the investment strategy, again, should ultimately guide how much risk is appropriate to take on within any given portfolio. And when we better understand those risks, we can blend that information with the normal quantitative analysis or the balance sheet financials that I just mentioned. This approach can really complement or be added to any actively managed funds analysis process. So investments or companies that appear to essentially match each other from a financial opportunity standpoint, we can then add on that qualitative ESG layer during the review process. So, another really basic example, two competing companies, both have strong financials, both, again, thought leaders, but one is located on a fault line and may be more susceptible to earthquake challenges, damages, delays in the production line. Clearly, that's, again, a little bit too basic, but just something that is common sense, but is actually an ESG related review that you might not consider ESG. Just as with the best-in-class approach that we discussed, this also doesn't need to necessarily review companies from all three factors. You don't need to review environmental, social, and governance perspectives. It can be chosen based on, positive screening on any one of those elements. So again, we're not reducing our investment universe. We're not limiting diversification. We're just having a better understanding of the risks. One of the headwinds that ESG investing has faced domestically, and I touched on this, earlier related to performance or criticisms, but specifically the United States has not done a great job of requiring or regulating factors related to ESG reviews of companies. Early last year, the SEC adopted a rule that was going to require disclosures related to climate risks. However, just a few weeks ago, they essentially voted to end that rule. So it's that not surprising political ebb and flow back and forth. So when they passed the rule last year, it was immediately being challenged. The vote to end the rule is already being challenged. Just like that, ebb and flow that we see. However, outside of the United States, Europe has actually standardized and passed a law that will require climate-related reporting. And these risks need to be reported along with their financial statements. So we just described, that layering of the two, quantitative and qualitative factors. And in the very near future, Europe is going to be providing that with us. So they're implementing a layered approach on what companies need to report, and that reporting is beginning now. They also, within that, it was the Corporate Sustainability Reporting Directive, within that legislature, they're also going to begin regulating the companies who provide ESG ratings of other companies. So that's a little bit confusing, but basically, there are companies and entities who evaluate other companies based on ESG factors. They then provide a score based on their findings and analysis. And this scoring is often used when creating an ESG portfolio. The risk and rating scoring system has really taken off since the Paris Climate Agreement, which was agreed upon in 2015, was signed in 2016, and the chart we're seeing here illustrates the number of companies that have been reviewed or evaluated for ESG risk factors. So it's the period between 2014 and 2022. And as a reminder, 2016 is when that Paris Climate Agreement really went into effect. And you can see how exponentially the number of companies that have information from an ESG risk perspective has expanded. There's more resources behind it, and there's more information available because that Paris Climate Agreement also required some reporting and updating on goals, but also it just prompted the interest. So we've seen that progress, and the availability of this risk rating information could also help to explain the increase in ESG focused investment products and assets, throughout the world. This chart is illustrating to us how many assets are invested in ESG funds throughout the world. We talked about how Europe is already requiring some reporting, and you can see here the bulk of ESG investments are held within Europe. Again, likely connected to that transparency.
Yeah, Kali, if I can pause for a second on this slide and touch on the dip you see in 2022. 2022 was just a rough year for markets, financial markets in general. We were dealing with rising interest rates, inflation concerns, and geopolitical instability, particularly the Russia-Ukraine war. And we also saw some underperformance of ESG-heavy sectors like tech, combined with a surge in performance of energy stocks, which are typically something ESG funds tend to exclude. On top of that, ESG was facing a little bit of skepticism and criticism for so-called greenwashing. That's a term that you're unfamiliar with. Greenwashing is when a company or fund misleads people into thinking it's more environmentally friendly or socially responsible than it actually is. So that caused some outflows, but overall, this was really just the perfect storm of bad performance, political and regulatory pressure, and broader market declines.
Thank you for that background, Mallory. You're exactly right. I mean, the greenwashing criticism, that's what we're talking about today, right? It's not just sustainability. We're looking at other factors. And even with the dip from 2021 to 2022, you can see that it has continued to grow along with markets, right? Has recovered and could, assume that the trend will continue. What's interesting, about access to more ESG risk ratings, and again, touching back on that, we're not trying to be exclusionary. These risk ratings clearly demonstrate that avoiding ESG risk altogether is nearly impossible. ESG risk is inherent and present across the entire investment universe. The chart here is showing us, of the companies that were reviewed for ESG risk, the levels of risk that can range between negligible to severe, and what percentage of companies evaluated fell within each category. So only 2% of companies were found to have negligible ESG risk of 12,000 plus companies reviewed.
Like you mentioned, Kali, this chart really does a great job of showing what you might be giving up with an exclusionary strategy. Avoiding companies with a medium to severe ESG risk would wipe out about 75% of the investment universe.
I don't think anyone would accept in a or would be difficult to accept when building a diversified portfolio. And maintaining diversification throughout location, throughout asset class and sectors is very important to our portfolio construction, and it would be very difficult, especially when looking at this chart, which shows the different sectors and how inherent, again, that ESG risk can be within a sector as compared to others. So this slide is showing us that on average, just comparing the top line with the bottom, the energy sector has essentially double the ESG risk as real estate. So that's not surprising. When people think of ESG, there was oftentimes with that energy exclusion. Everything we're seeing here, all of these different sectors are considered typical within a diversified investment portfolio. So understanding these scores, seeing how broadly ESG risk affects companies throughout the world, throughout all industries, it can help us to better understand why now we use ESG as an additive layer of our investment approach.
Yes, it's just another example of why we have progressed away from the exclusionary ESG strategy towards more integrated and proactive approaches. So over the next few minutes, I'm going to walk you through how we approach ESG investing here at the center. My goal is to make sure you leave with a solid understanding of both our social strategy and the investment process behind it. So let's dive in. We're going to start off by talking a bit about the construction considerations of the center's social strategy, which is our response to investors who want their investments to reflect their values and still meet their financial goals. ESG funds tend to get a lot of attention for their security selection, when in reality, that's really just one small piece of the puzzle in what we consider when creating an impactful investment strategy. What sometimes gets overlooked are the core construction fundamentals that really form the backbone of these strategies. These fundamentals support our firm's investment philosophy, and they play a huge role in helping you reach your financial goals. So we can safely say that these are extremely important components to our process, and not only are they important, but they significantly contribute to an investor's chances of reaching their financial goals. Take asset allocation, for example. Asset allocation is the stock to bond ratio suitable for one's investment goals. Conservative research attributes 40% of investment performance to asset allocation, while liberal valuation suggests as much as 90% of investment performance can be attributed to asset allocation. It's a pretty wide range, but you can really see that it's an extremely important step that cannot be overlooked, as it essentially lays the foundation for your investment plan. It's also something that you and your planner likely talked through in detail and agreed upon when you discussed your goals. And much like those goals, asset allocation is something that may change or evolve over time, depending on you and your situation. Next up, I want to highlight fee sensitivity. The reality is that investment costs add up, and the compounding effect of those costs can diminish returns. For that reason, considering the cost of funds is a vital part of developing investment strategies and something we pay close attention to. And this is not specific to ESG investing alone. You're going to see this with traditional strategies as well. Diversification is another key part of our philosophy, and it largely influences our preference for ESG investments over other values-based strategies, many of which Kali mentioned earlier, but in particular, we're referencing those that rely heavily on exclusionary practices. Bottom line is, ESG does not replace the core investment process, it adds to it. So you shouldn't feel like you're giving something up to invest this way. In fact, I really want to highlight that security selection is just one part of the whole process. There are many other components that have a bigger impact on your long-term success. That being said, let's go ahead and talk security selection now, because that is still an important part of what we do. Our ESG strategy goes through the same rigorous screening process that we have always used, which include both quantitative and qualitative screenings, but I want to touch on 4 key things here. First off, we make an effort to work with companies that have a reputation for walking the walk. And this is really important to us, and we often pose it as, do they eat their own cooking? Or in other words, do they invest in their own products? We want to work with fund managers who have demonstrated a long-standing commitment to values-based investing, whether that's through engagement with companies to improve their behaviors or using shareholder voting powers to advocate for better company governance. Second thing, we really like to review performance over full market cycles. This allows us to weed out the trendy funds that haven't been tested by time yet. We're just looking for strategies that really hold up over the long haul. Third, we have face-to-face meetings with fund managers and company representatives before we add any funds to our strategy. And that doesn't just stop once you're in. Just because you made the cut the first time doesn't mean your job is done. Ongoing due diligence is a big part of what we do, and we want to make sure every fund continues to perform the way we expected. Fourth and last, we run our funds through routine criteria checks to ensure fund continuity. We don't want a fund that starts out supporting one area of diversification and then slowly morphs into something else. So we're constantly reviewing to make sure everything is still aligned and serving its intended purpose. So those are the key aspects of our investment process, and I'll leave you with this final thought. When we implement these types of strategies, have peace in knowing that we implement them with your best interest in mind. If a full overhaul of your portfolio isn't the right move, whether it be for tax reasons or just personal comfort, we won't force it, and that's not the direction that we would go. Instead, we'll look at how to gradually transition your current portfolio into ESG investments in a way and at a pace that makes sense for you. At the end of the day, we're a financial planning firm. We evaluate these things through different lenses and different perspectives. If ESG investing is something you want to explore, we'll make sure it's done thoughtfully without disrupting your overall plan. Our job is to help you reach your goals, not throw you off track. Every situation is going to be different, but the investment team and your financial planner are going to work together and make sure we are doing the right thing for you. Wanted to make sure that that was emphasized before we move forward. But I think that's about it from me. I hope that helps give a better understanding of our ESG process here at the center. And with that, I'm going to pass it back to Kali to wrap things up.
Thank you so much, Mallory, and thank you for mentioning that root in financial planning. Like you said, we're a financial planning firm, and although today we talked a lot about investing and investment approaches, it does not mean that we think any investment portfolio should exist for our clients without that financial plan process. We always believe that your portfolio should be rooted in a financial plan, and that is what leads us to the right allocation. That's what's actively managed on your behalf and, of course, updated as your life changes. But thank you all so much for your time today. I know we blew through a lot of information, so thanks for hanging in there with us. I hope you're leaving feeling like you understand a couple different new things about ESG. But of course, if you have any questions, don't hesitate to email Mallory or myself. And the center is always here to help you or anyone you care about. We really appreciate your time and have a great rest of your day.